Hello everybody, this is Daniel Zabala, and in today's video we're going to be talking about building wealth. And I will attach the slideshow that we'll be using in this presentation in the description below, as well as the website where I have all the material that I put together just to be a free resource and a blessing to people. So in this video, like levels 1 and 2, uh, which were more about just basic overview of finance and personal finance, um, we'll be looking at wealth building or money from kind of three different perspectives, just kind of intertwined into one in this presentation. We're going to look at it from a academic standpoint, as I have an MBA and a Master's in Finance. We're going to be looking at it from a real world application standpoint, like how you actually do it. And then we're going to be looking at it as well from a biblical standpoint, because God in the Bible has a lot to say about money and how to build wealth. Lots of wisdom in Scripture about how that works. So let's dive right in. This presentation is about 39 slides. I'm going to go kind of skim over most of the slides, just kind of make it quick. Hopefully it won't be too long, but there's a lot of great material here. So starting off, wealth and wisdom. So gaining wisdom is the wisest thing you can do. And whatever else you do, develop good judgment. That comes from the book of Proverbs, chapter 4, verse 7. So gaining wisdom is the wisest thing we can do, for sure. So wisdom is more important than the building a wealth, but they kind of go hand in hand a lot of times. What we'll be talking about. So these are the core concepts we'll be taking a look at. Some more in depth than others. We're talking about cash flow and what that is. We're talking about assets and asset creation. Lessons that I personally learned from business school, owning a business, real estate, the stock market, commodities, cryptocurrencies, and taxes. So let's keep on moving. So how to create wealth. It's all about cash flow. Cash flow, cash flow, cash flow. So your personal financial statements, every company has what's called a set of financial statements. They have an income statement, a balance sheet, and a statement of cash flow. Okay, so but as individuals, we also have personal financial statements. We have a balance sheet and an income statement. So most people focus on the liabilities column of the balance sheet. The balance sheet has assets and liabilities. Okay, liabilities is stuff that takes money out of your pocket. All the cars, expensive clothing, TVs, electronics, and all the junk and stuff, right? Takes up your time, your energy, and your money. And then in the form of expenses, it goes out the door, right? So income for most people comes from their job, their place of employment, or if you're self-employed, but can also come from business income and asset or passive income, right? So rental properties, dividend producing stocks, books that you've written and you can receive royalties on. If you create an income producing website, or maybe own some vending machines, or a laundromat, or small business, or a business with any number of employees that you've hired, these are all assets. Okay, so we want to create and or invest in or purchase income producing assets that puts income in your pocket you can live on and build wealth off of. So this is where you want to focus your energy and efforts, is acquiring and creating assets. So this I call the uh, trinity of wealth building, if you will, just a concept. So you kind of have four main areas to building wealth. You have business, or your primary source of income, like your job. But if you really want to build wealth, it's creating a business that has employees that you hire. If you have employees, you're using leverage, or if you're using loans, or investors to help you fund the business, that's using leverage. There are tax advantages to owning a business, and it's ideally scalable. You can grow it, unlimited growth to the upside potential. The stock market, it's very liquid, meaning you get in and out very quickly. You can use leverage in the form of stock options and even margin accounts, which we'll go into more in depth in future videos. It's agile or flexible, and it's also scalable. The sky's the limit. And then you have real estate. You can use leverage through the form of having a mortgage on a rental property, and it's scalable. And then also created assets that you have created. Okay, so there's infinite returns and possibilities with created assets. Created assets is represented by this, the ring. Okay, So, examples of created assets. Again, excuse me, books that you've written, you'll collect royalties on if you can have an ongoing sales on those books. If you have software as a service that you maybe created, music that you've composed, photos that you've taken, you can sell online, like through Pixabay or different platforms online, patents that can be licensed to other companies, income-producing websites, YouTube channels, and business employees, and so on and so forth. So creating assets is very challenging. To create an income-producing asset it takes a lot of work, a lot of effort, but once you have it created and it has a consistent stream of income, you can grow that, and that's really where to build wealth, where is a really, really big aspect of it. So creating assets, owning a business, stock market, real estate. This I call the cash flow activity matrix, which kind of shows you examples of the difference if you're working in finance, like stock market, real estate, business, and even agriculture. My personal hobby and one of my passions is sustainable agriculture. So this is an example to how it all kind of overlaps and how it can all be applied to these different concepts. Capital gains is when you buy something low, so higher for a profit, right? And cash flow is ideally coming in from passive income through those dividend-producing stocks or those residential rental properties. So under finance, you have day trading, swing trading for capital gains. Selling options is a sweet spot. It's kind of a hybrid, or it can be a hybrid between capital gains and cash flow. Long-term investing, dividend-producing stocks. Real estate, if you're actively working in real estate as a realtor, you get referral fees. If you can go out and wholesale contracts as an individual, it's very risky and you have to be careful. Liability-wise, you could get into trouble legally if you don't know what you're doing, don't do it right. Serving clients, fix and flip, these are all capital gains. Sweet spot if you have an Airbnb, motels, hotels, so forth and so on and so forth. Horse rental stalls, if it's self-service, that's a wonderful way to have like passive cash flow income. If you have a farm, you have say 10, 20 stall barn, you could rent some of those stalls out to other people, and even self-service, meaning all you do is provide the stall, but the owners have to do everything. That's a great way to have investment income. I live in Lexington, Kentucky, and there's a gentleman that has a farm behind Keeneland, which is a racetrack here in Lexington, and he has, I think, 2 or maybe 3 or more barns, and I know that's what he does. He does self-service horse stall rentals, and I think he charges like $250 a month, but the owners have to do everything, and he has a lot of cash flow coming in from that. And he also does barn dances for fun. Fun fact, they're just fun. He'll do them in the loft of the barn just for fun. So it's pretty neat that he does that. But yeah, just as examples, business, and you can read through this on your own. And then agriculture. This is more of a timeline type of thing, but microgreens, leafy greens, mushrooms, garlic, these are all things that you grow and harvest one time, right? Worm castings is an example because you can cultivate the castings or worm poop and store them. They don't go bad in a short period of time like these items would. And then if you have, livestock or asparagus, berries, grapes, fruit trees, this all produce fruit or vegetables on 1 year after another. They keep producing once they're planted and last many, many years. I'm not going to go over this in depth, just as a review. We've seen this on levels 1, 2, and 3 of this educational course that I'm creating. This shows how long it takes money to double at a given interest rate. Invest $5,000 one time at this age of 25. If you get 3%, it doubles and doubles. If you can get 6%, doubles every 12 years. If your money could get 12%, it doubles over 6 years. And if your money could get 24%, it'll double every 3 years. One time invested at $5,000, if you could double it every 24 years, which is actually attainable, and the people that are wealthy and first generation millionaires and professional investors, they're looking at numbers like this and higher. They probably don't even fool much with this unless it's for a hedge or instead of cash, just to keep up with inflation. So very, very attainable. Most people don't know that, but it is possible. some more verses from Scripture. So this is three different versions of the same verse. Okay, so Proverbs 13, verse 11, English Standard Version, New Living Translation, New King James Version. My personal favorite is the English Standard Version. Wealth gained hastily dwindles away, but whoever gathers little by little will increase it. So keep in mind, definitely always be wary of get-rich-quick schemes. There's no such thing. But you work hard and you save and invest and gather little by little, it'll grow, right? Here we go. Very wealth from get-rich-quick schemes just quickly disappears. Work hard. Yeah. So moving right along, and just to review this again. So we went an overview of creating assets, business, stock market, real estate. Now we're going to dive into business more specifically. Okay. So this is the cash flow quadrant from Robert Kiyosaki, who's the author of Rich Dad Poor Dad. His material is a lot of good on basic concepts, but his material I find doesn't have a ton of meat. A couple of his books do, but he is a salesman, and so he kind of teaches. He's been teaching the same thing for years and years. Very simple concepts, but it's up to you and me to dive in further to really educate ourselves at a much deeper level beyond the basic concepts. But for example, employees, self-employed, business owners, investors. So we've gone over this in a previous, I think it was level 2 where I explained this, but just a quick review. If you have a job, you're trading time for money. There's no leverage involved, and you pay a lot in taxes. If you're self-employed, you own a job. You also trade time for money. There's no leverage, and you pay even more in taxes on a percentage basis. But when you move over to the right side of the cash flow quadrant, business owners and investors pay less in taxes on a percentage basis. Most people don't know this. The government incentivizes certain behaviors. To those behaviors is creating jobs and providing housing. If you do those, you're rewarded by having to pay less in taxes. Business owners own a system. They hire people who produce money for them. That's leverage. And investors make money work for them. Money makes more money grow in the form of passive income. Okay, like rental property, dividend producing stocks, using stock options and futures contracts in the stock market, things of that nature, or just good and wise, profitable investing all around. So this side pays less in taxes than this side, and this side tends to make a lot more money than this side, especially once you get into that millionaire threshold. So some advantages to owning your own business. Tax advantages on the income, lower rates, you can depreciate certain assets, there's tax deductible expenses. Even if you're self-employed, I mean, having that small business for yourself, there's a lot of tax advantages because you can write off certain deductions. So you'd always want to talk to a CPA, but for example, last year I bought a new computer for my real estate company, and that was a complete tax write-off, so that reduced my taxable income. A camera that I bought, also tax write-off. So all that equipment, miles can be deducted a lot of times. Or if you buy a new vehicle, depending on how your CPA does it, they might, instead of deducting miles, they might be able to take some of that purchase price and use that as a tax deductible expense, or depreciate that asset if it's owned by your company. So a lot of tax advantages to owning your own business. So it's something definitely to keep in mind. And if nothing else, I would encourage everyone to learn about business and start a small side hustle business. Be self-employed. Even if you have a full-time job, start a side business so you can take advantage of some of those tax advantages and do something that you're passionate about, providing a product or service for other people. When you have a business that has employees, you get to utilize the advantages of other people's everything, right? So other people's energy, times, talents, skills, resources, all of that when your employees are working for you. That's a huge form of leverage, especially with innovation and creativity. Unique type of retirement accounts, for example, SEP IRA. It's like a traditional IRA, but you can contribute more as a business owner or self-employed than you can with just your regular traditional IRA. Also, likewise, a Roth Solo 401k. It's like a Roth IRA where it's taxed in the backside, but you can contribute a lot more to that from your business as a business owner, self-employed individual, potentially more than $6,000 or $7,000 a year. So that's huge, tax-free on the backside. So another great potential opportunity there. So even if you had a side hustle, small business on the side, whether it's food truck or a realtor or whatever, if nothing else, you might do that and say, hey, I'm going to do this because I love it, I enjoy it. The potential to one day maybe go full-time in my business, have the tax deductions, be able to write off certain assets that I purchase, or not, well, I should say, not technically assets, but, things like computers and vehicles and things like that, potentially. Always talk to your CPA first. And your retirement account. I mean, you might say, hey, if I can make $10,000 a year from this side hustle business, I'm going to invest. You won't be able to invest all of it, but even if it was half, it just depends on your situation. What if you could invest half of that in your Roth solo 401k, for example? I mean, that'd be great if you did that every year. So, a lot of growth potential, be your own boss. So, a lot of great advantages to owning your own business. So here is a list of the most valuable lessons I learned personally from going to business school, Master's in Finance, as well as my MBA, Master's in Business Administration. Now, I'm not going to explain what these are. The slideshow, like I said, is attached the link to it is in the description below this video. But these are great concepts to look into and understand on your own. Just so you understand how this works, this is kind of like a key. So the blue is economics, green is marketing, negotiations and conflict resolution is this yellow, and so forth, right? And this gray is just kind of by itself. Supply chain management. So these are really, really important and great concepts to do a Google search on your own. And I'll be making future videos as well as on these individual topics. But this is just a great list of some great concepts to dive in your own and look into to learn for yourself for business and finance and investing. So what they don't teach you in business school, they don't teach you about real estate using a mortgage to finance the purchase of a investment rental property. That's a real world application, right? As a Christian entrepreneur, it's kind of a gray area. It's ideally we don't want to be in debt at all as Christians. Want to get out of personal debt completely, for sure. But for investment properties, it's more of a gray area. And the reason I say that is because of if you really know what you're doing and you have the potential to really make that money work on top of itself. There's always risk involved. If anything, there's the wisdom of you never want to have too much debt. It's wise to have no debt, and it's wise, especially if you're going to use debt to purchase rental property, to really be careful and manage that. So that's more of a gray area, and for each person to decide for themselves, like whether they personally feel it's okay to do that. Owning a business, other people's everything, remember, and stock market, liquid leverage. So these are things that they don't teach you a whole lot. Not really what you need to know for becoming an entrepreneur and building wealth. They'll teach you other concepts, but they don't teach these things in necessarily the best way for real world application. Using other people's everything, again, by creating jobs. Okay, this is another form of leverage. Some more scripture. So where there are no oxen, the manger is clean, but abundant crops come by the strength of the ox. So kind of the takeaway is invest in the right tools and equipment to help you get the job done more efficiently and effectively, right? So if you own a business, if you own a small farm, for example, have that tractor, or if you are a plumber, make sure you have the right tools, whatever. You want to have the right tools and equipment to get the job done more efficiently, more effectively. That's really important. And this verse can be, you can look at it from this perspective. An empty rental property stays clean. There's no hassle associated with it, but a tenant brings in the income, right? So if it's not rented out, sure, it's clean. You don't have that stress, but you have stress because you don't have a tenant bring in the income, right, from that rental property. So wisdom from Scripture. So going back to this, so we went over kind of created assets. We went over having a business. Now we're going to get into the stock market and real estate. Okay, so this is two different examples. So I would encourage everyone, and please keep in mind in my videos, I don't give specific investment advice, and definitely these videos are simply for entertainment and educational purposes only. But, I'm sorry, and I should say, so this next example is just an example. Okay, what's your financial freedom number? And so the important thing to keep in mind here is you always want to diversify your investments wisely. You never want to have all your eggs in one basket. So I'm not saying that one is better than the other. Having a business is not better than investing in the stock market, which is not better than investing in rental property. I think it's wise and important to do all of it, a little bit of it all. You want to focus your efforts. You don't want to be spread too thin, but it's wise to have diversification in unrelated endeavors, right? So rental property. So if you had 4 rental properties paid off with cash at $150,000 each, that costs you $600,000, right? After taxes, your estimated gross income will be roughly $12,000, right? Give or take. This is just a simple example, assuming that you got this much in rents each year with no vacancies, so which isn't going to happen. But just assuming this was the case, your return on capital would be 8.6%, right? So estimated annual gross income of over $50,000. This is assuming you bought those properties with cash. Likewise, if you had a stock portfolio, invested $1.5 million in stocks at an average rate of 8% per year, that means you would have roughly 2% to live off of, because you want to have 4% of that growth to account for inflation and another 2% to account for taxes and fees, right? So that 4 plus 2 is 6, so 8 minus 6 is 2. So that gives you 2% in quote cash flow, if you will, or you could take off the total capital from the account. That would give you about $45,000 in gross income. So if you're thinking long term at your retirement, for example, things to keep in mind. It's like if you're going to do rental properties, what kind of numbers do you need to have to reach this kind of income? Likewise, a stock portfolio, what kind of numbers do you need to have to reach this kind of gross income? Now keep in mind inflation, right? So, 30, 40, 50 years from now, these amounts are not going to be worth what they are today. It'll be like a fraction of what this is worth today, right? Because of the value of the dollar over time. So to keep that in mind, right? But important to understand. In these two examples, the income is virtually the same or close to the same, but this is less than half the amount of money invested. So again, I'm not saying one is better than the other. It's important to diversify, right? It's just things to keep in mind. If you're only invested in the stock market, if you already have a good chunk, well, maybe it's time to look into rental property as to add to your investments. In addition to that, real estate also has tax advantages. You can depreciate the value of the properties if you use a mortgage. Interest is tax deductible, all kinds of stuff. So things to keep in mind. So using other people's money in the form of leverage for rental property, residential, commercial, like apartment buildings. And there's syndications, which allows you to invest in a big commercial real estate property, for example, or some type of real estate investment with a lot of other people. So you're becoming a full-blown owner, but you reduce the risk by having multiple owners. You're not the only owner, right? So will remove a lot of that liability. If, for example, a tenant gets hurt and they try to sue you, well, they're not suing you, they're suing the company, and so your risk goes down in that kind of example. And commercial real estate especially has some major advantages. It tends to be larger cash flow amounts than just single-family homes. There's the tax deductions as well. And the type of loans. A lot of times with single-family homes as a rental, pretty much your personal credit is what's going to secure that loan for the property if you're using a mortgage. On commercial properties, it's the property itself that secures the loan based on the projected cash flow income potential, or what it should cash flow, especially if it already has tenants when you purchase it. Then in that case, you want to make sure to get the property to secure the loan. That way, worst case scenario, if your tenants all vacate and you're left with a property with no tenants and they had to foreclose, the close on the property itself, it doesn't ding your personal credit, right? And again, these are all things to talk to a CPA and as well as an attorney about. Make sure you know what you're doing when you get into something. Don't just go into it blindly. You always want to have a great team of professionals working with you and for you, people that know significantly more than you do about what you're doing. And multiple tenants, obviously, that spreads out the risk than just having a single family home with one tenant. Okay, so most important skills for whatever you're doing, whether it's as an employee, in business especially, this is a list of what, in my opinion, are some of the most important skills to learn and acquire. Notice I said learn and acquire. The ones in red are personal ones that life lessons that I've grown a lot in, especially in my 20s, my early 20s. These are major lessons that I had to learn and be instilled in me. The importance of listening well and being effective at communication. Listening is so important. Most people in our world today don't know how to listen, it seems like. Truly listen to one another. If you want to gain people's trust and respect, and really show them that you care and that you love them the way God calls you to, listening is such a powerful thing for that. And then the ability to be flexible and agile in your work also is really important. We'll also think focused on the goals and tasks at hand. And being more efficient, to be more productive, right? And then the ones in blue here, if you're in business of any form, definitely, so in my opinion, the most important. The networking, building relationships, marketing, advertising, sales. So this is a famous quote. The pessimist complains about the wind. The optimist expects it to change. The realist adjusts the sails. So I remember I saw this when I was in the Navy, and that really stuck with me. It's like it's good to be optimistic, but don't. You have to be real as well. When something's not working, the definite. I think Einstein said the definition of insanity is. I don't remember who said it actually, but the definition of insanity is doing the same thing over and over and over again, expecting different results. So, like, people in our culture, especially today, love to complain about everything and blame everybody else. Instead, take responsibility for your own life and your own actions, and we all need to do that. And speaking to myself here, instead of complaining, change what you can and don't worry about what you can't, and adjust the sails to your life. Adapt, overcome, and move on. Don't waste energy and time. It's too precious, too valuable on complaining or worrying, or something's not working. Sucks, but move on. Move forward. Do something else. Don't wear yourself out trying to get rich. Be wise enough to know when to quit. Proverbs 24:23. So a big important takeaway is to trust in the Lord and do not idolize wealth or financial security. In the United States of America, this is a big problem for us. We idolize our country, we idolize wealth, we idolize all these things. But really, we should trust in the Lord. Work hard, be wise, plan. Do what you can. Nothing wrong with obtaining wealth. But it's unwise to just put everything into it and idolize it. Learn how to balance your efforts while keeping your priorities straight. As a Christian, it's all about Jesus. He has to be our priority. After him, our family has to be second, and our work has to be a major distant third, whatever that work is. So moving on to the stock market. Stocks are liquid. You can utilize leverage in different forms, and they're agile, they're flexible. A lot of different ways you can approach the stock market. So for most people, if you're investing, for example, in your 401k, The cash flow you're receiving is from dividends, which is the distribution of earnings. But a lot of people don't know this is a thing. You can also increase your cash flow by using options, stock options, okay? And I'll talk about stock options more at the end of this presentation, and I'll be doing, I think it's levels 6 or 7, or maybe level 8, when I in these presentations that I'm putting together, where I really go into depth of what stock options are, how they work, how to trade them, and a very full in-depth process to how they work. But cash flow from options, when you use options utilizing leverage, they're great for hedging your portfolio risk. For example, if you have an investment of stocks you're hoping to go up over time, if you use options, you can hedge the downside for the short-term downside risk. You get exposure to other markets like currencies, commodities like oil, natural gas, gold, silver, exposures to bonds, and opportunities based on high volatility. Volatility is the swings in the market. When the market is going crazy, like it has been the last year now, 2020 to 2021, when you're trading or trading options, that means a lot of opportunity when the market's very volatile. When things are slow and steady and smooth, that's when investing for long term really maybe outweighs the advantages. But utilizing options is great for when there's periods of high volatility, big swings in the market, right? The world of finance. Be sure to know the condition of your flocks. Give careful attention to your herds, for riches do not endure forever, and a crown is not secure for all generations. Proverbs 27:23-24, New International Version. So the takeaway from this is to monitor and adjust your investments with careful thought and attention. Don't ever just pay someone else to invest for you and then not pay attention to it at all. And don't ever just trust somebody else with your money completely. In the beginning, your job, your 401k, it's maybe how you start, but you always want to educate yourself more and more over time and monitor those investments over as well on a consistent basis. That doesn't mean buying and selling all the time if it's your 401k investment account, like changing things in the account daily, weekly, or even monthly. You don't want to do that, but you want to monitor things and adjust them over time to make sure that you're being wise and taking care of what God has trusted us with. And I say you a lot, but I'm talking about myself too. Now, I'm not going to go over all the details, but this is where we're going to talk about stock options in a very simple way, utilizing covered calls. Okay, so a covered call would be, for example, let's say a stock is trading at $100 per share, and you own 100 shares. Okay, so you have $10,000 invested in this company's stock. Okay, what you can do is you can sell a stock option, which is a form of a derivative. Okay, that's a financial word, derivative. You own the stock here. You can sell a call option against the stock that you own. So you own $10,000 worth of stock at $100 a share today. You might sell a call option contract, which is like an insurance policy, to the market. Okay, that contract has 45 days to expiration on its life. Okay, if you own a car, you have car insurance, which is a yearly policy, so for 365 days till the policy expires. If you own a house, you have mortgage insurance if you have mortgage, or you may have mortgage insurance if you have conventional loan. You have insurance on the property, right? Which is a yearly policy. This policy is on stock, and this contract has 45 days expiration. But you're not buying this policy; you're selling it to the market. So you're becoming the insurance company here, right? So you own the stock, you sell a 130 strike call option contract. The probability that the stock price in this 45-day window is going to stay below $130 a share is 16%. Meaning, well, I'll back up real quick. By selling this contract, let's say you collect $1 times 100 shares is $100. Okay? You sold the contract at 130. You have an 84% chance that the stock that you own will stay below $130 per share. Okay? So worst case scenario, when you own this stock for the long term, right? You don't plan on selling it, even if it goes down short term. You don't plan on selling it, right? Worst case scenario, you have to sell your stock for 31% profit. Why is that? If the stock price goes from $100 to above $130 a share in this 45-day window, you're forced to sell the stock that you own at this price. Okay? But you collected $1 or $100 for selling the contract and you own the stock. So your break even is 130 plus 1, which is 131 a share. 131 minus 100 is $31. $31 divided by 100 is 31% profit in a 45-day window. That's phenomenal, right? So this is a win-win-win situation. Okay, so again, you own the stock, you sold this contract. Worst case scenario, the stock goes up, blows through this number in 45-day window. You have to sell at a profit. Okay. In the short term, you own the stock, you sold the contract. Say the price comes down temporarily. You don't plan on selling the stock because you want to own it for the long term. Worst case scenario, say the price drops to $95 or even $90 or $80 a share. Okay? You own the stock, you sold this contract, 45 days is up, this contract expires worthless, you made $100 in addition to you own the stock, right? So that is a win-win-win situation. This is called a covered call. You own the stock, you sell a call contract against it. Okay, so that's on the upside. A cash secured put is this. Let's say the stock, this is a different company, okay? Different company. You don't own the stock, but you like this stock and you want to own it, but you're not willing to pay $100 a share for it. Today, this company is trading at $100 per share. You like this company, you're not willing to pay $100 a share, but you're willing to pay $70 a share. So you can sell a put option contract at a strike price of $70. Okay? Best case scenario here, because you want to own the stock price over this 45-day window drops down below $70. You're forced to buy the stock at $70. It might, if it dropped to $50 a share, you'd still be buying it at $70. But in your mind now, as of now, you're comfortable with buying the stock at $7 per share, knowing that you plan on investing in this company for the long term, right? So your break even here is actually, it'd be $69 because it's 70 minus the $1 you collected. So you'd actually essentially be buying the stock at $69 a share. Okay? That's worst case scenario. Assuming the stock did go bankrupt and went to zero, right? Which are highly unlikely if you're doing high quality companies. And then, another scenario might be the price is here, you sell the contract here, the price goes down to 90 or goes up to 110 or anywhere above 70. Okay? In that case, you collect the $1 or $100 for selling this contract and you never buy the stock. Okay? And you have an 84% chance that the stock price over this 45-day window is going to stay above $70 a share. So in this case, you can read this description below. So this is just a quick little brief overview of how a cash secured put works. Okay, for investing for long term, it's a way to buy low in order to get into that position. So commodities, this is just overview what they are. They tend to hold their value. Okay, gold and silver, coins, bars, guns and ammo, oil, natural gas, wheat, corn, bean, or sorry, wheat, corn, beans, wheat, corn, and soybeans, and cattle, right? So these are examples of commodities, hard commodities, soft commodities. Cryptocurrency. Quick overview. We're almost at the end of this presentation. Cryptocurrency, another way to diversify your investments, or speculation, if you will. One thing I learned in graduate school is kind of one more effective way. If you're gonna put money into cryptocurrency, you want to do whatever's the biggest coins, meaning has the biggest market cap. The reason for that is the network effect. The bigger the market cap, the stronger the token or coin in the cryptocurrency world. This is one of the very most important factors. If the coin is made correctly, for example, like Bitcoin, it's unhackable. No one person, country, or company controls it. In the example of Bitcoin, not the case for all cryptocurrencies. I know that, I think it's, I forget the name of it. My mind's been blank. It's not Litecoin, I don't think. Maybe it's Litecoin. There's some token or cryptocurrency coin that's gotten in a lot of trouble recently. It's owned by one company, and so that one's not doing well. But like, for example, Bitcoin, no one person, country, or company controls it. It's decentralized. And you also want to look at what's the use or the application for that token, that coin, that cryptocurrency. Be sure to ask yourself these important questions, and these are keywords. Token, coin, cryptocurrency, all used interchangeably. It's important that you understand what blockchain is. Blockchain technology is the underlying technology behind cryptocurrencies that make them so interesting and important. So I'm not going to go into explanation of how fundamental analysis works, but I have put this is just a really brief summary of maybe how you might look at a company. Okay, fundamental analysis is used to determine what is a high quality stock and what's not, if you might want to invest in it or not, as well as how profitable and the potential returns and cash flow, future cash flow and future profits, what those might look like, right? So this is something you learn in I learned in the Masters of Finance. This is what you learn in school, is how to do fundamental analysis on a company. You can also do fundamental analysis on rental properties. That's different, but this is for publicly traded companies or stocks and equities in general. You want to look at the return on capital, the cash flow, the financial health, and the worst case scenarios. Ask yourself important questions. These are all important metrics to look at and understand. So these is ideally you want these metrics to fall in line here, right? You also want to ask yourself these questions about growth. Again, these slides are in the description below. You also want to look at management. How are they being paid? What's their lifestyle like when they have company business meetings somewhere? If you could find out, are they staying at the most expensive hotel in town under company money, or are they paying out of pocket? Are they maybe staying somewhere more modest? If they're staying at the most expensive hotel in town on company money, probably a company to steer clear of. That's a bad sign about the character of the management and how they're going to run the company. All important aspects to learn about and look at. And last little bit is taxes. So this is the very last slide, I think. Yeah. Well, second to last slide. It's important to understand the type of income you have. There are 3 types of income. They're taxed differently. Ordinary income is your job or your salary, which most people have, right? Portfolio income is that capital gains income, whether it's through stocks, real estate, flipping properties. You're buying and selling guns or coins or whatever, antiques, capital gains income, portfolio income. And passive income, rental real estate, dividends, interest, and royalties. So these are taxed differently depending on the type of income as well as the product itself, right? And different type of assets also have different depreciable lives, which you learn about in accounting. For example, a single family home that's a rental property, as of now, as far as I know, you can depreciate over the course of 27.5 years. A commercial property, like apartment building, might be 39 years, whereas cattle or a vehicle or different things, well, like a rental car, if you own a fleet of rental cars, they might be a few years, and they all vary and differ. If you don't understand what depreciation is, you know, I encourage you to look into it, do Google search, and learn more about that. But that's another huge benefit of owning assets, is those are tax write-offs if done correctly. So, and for the average person, ways to reduce your tax liability, use the Roth IRA for make sure that the money at retirement is tax-free. Own a business. Have proper entity structuring for your business endeavors. Not all business entities are equal or the same. You definitely want to stay away from what's it called? Sole proprietorships. And certain states are more favorable toward businesses for taxes than others. Something to look into on your own. Investing in real estate is a way to reduce your tax liability, and make sure to use qualified and knowledgeable CPAs. That's it for this video, and it was a lot of information. I hope you learned a lot. God bless, peace, grace, and until next time, talk to y'all later.